We want to get your take on really what the impact would be of a quarter point, actually, whether it's October or November. But let's bring John Hilsenrath in, the Wall Street Journal chief economics correspondent, Anthony Scaramucci from SkyBridge Capital, and Liz Klayman, of course, at the New York Stock Exchange. John, you called it. I mean, you have been saying that the Fed will raise rates up until the last couple of weeks. Then you changed and said they probably won't raise rates on this day. It was because of the global story.
I mean, I've been saying that that they expect to raise rates this year, and that's still their expectation. But it became increasingly apparent to me in the last week or two that they're not prepared to raise rates now. And, you know, a lot of that was in what Janet Yellen didn't say. We got no signals from her going into this meeting that she was prepared to do this. And this is a very cautious woman, and she's just not in a position to surprise the markets. You know, the way I would describe the Fed's stance right now is, and Janet Yellen's caution is, this is kind of like a person who says, look both ways before you cross the street. So they're looking both ways. They want to make sure that what's happening overseas and what's happening in financial markets doesn't fundamentally change the economic outlook for them. And I think if they get comfortable with the forecast over the next month, or probably it looks increasingly more like into December, then they'll go ahead and do it.
Yeah, they're going to go ahead and do it. But I guess the question is, what is the impact of a quarter point? Mark, Zandi, what do you think the impact would be? I mean, you say you wanted them to do it, and you were disappointed. What changes with rates up a quarter point?
Maria, I don't think it's a big deal. If John is right and they go by the end of the year and start raising rates then and slowly raise rates in 2016, which is now the widespread expectation. If they do that, then no big deal. There shouldn't really be any change in equity prices. There shouldn't be any change in credit spreads, value of the dollar, commodity prices. We're all good. So it's not a big deal. It's a matter of judgment, right? It's a balancing of the risks. I mean, the risk that John articulated is if you go too early and then you have to step back if things go off the rails, you know, that's one risk. And then the other risk is if you don't go fast enough, then down the road you're going to have to play catch up, and that would hurt the economy. So it's a matter of judgment. They made a different judgment. I'm disappointed because if I were sitting on the Fed, I'd take a different perspective. But in the grand scheme of things, if it's today or if it's in December, I'm not sure that makes a big difference.
If you take one increase in and of itself, that's not a big deal. But we're talking about the Fed starting a process which is going to make investors very uncomfortable. Clearly, investors are going to be uncomfortable about it because this is all we've been talking about for the last few months. And I think it is a big deal when the Fed starts this process. And
so they just get over it.
John, they're not exactly comfortable with them leaving it where it is. I mean, am I missing something? They're not exactly comfortable today. Yeah. They're all over the place. I mean, this is not a comfortable market. This is a market that doesn't know what's going on.
There's a lot of uncertainty right now. But the point is, you know, the Fed has not lined up its ducks. Janet Yellen is giving a speech next week, which I think is very important. Once they start raising interest rates, they really have to articulate what it's going to look like after that. And they just weren't ready to do it today. And I think that's one of the things that she's kind of preparing.
I can't imagine what comes out of that speech next week. I can't imagine what comes out of that speech next week that we haven't heard today. I mean, we're talking about a global slowdown.
They have not clearly articulated. They have not clearly articulated what this process is going to look like once they start raising rates. Yeah. You know, there's going to be the question all over again. You know, all right, so you've done one. Well, how are you going to decide when to do the next one? I think they have to weigh it out.
Why is that so? Why is that such a risky thing? I mean, they've been here before.
Yeah, and by the way, we've lived through uncertainty, as Lou put it, ambiguity. Lou likes ambiguity.
For
decades with Alan Greenspan.
All right. So can I answer that question?
I don't understand why they have to give you every dot, and every dot, every I, and cross every T.
Here's why this matters. 14 central banks in the developed world have tried raising rates since the financial crisis. Do you know how many of them have been able to keep rates at a higher level?
We do.
Zero. None of them have. It's a big deal, and the Fed is cautious because we had a financial crisis, and no one has been able to sustain
so infantilized.
You're going to go back to 2007 now on the financial crisis? I mean, look, at this point in the cycle, you would expect that we would see a lot faster growth than we're actually seeing right now.
Companies have no pricing power. You know, I mean, I think Scaramucci would agree with that.